Hey everybody, welcome back. It's John at Rain King LLC. It's time for a general market update. It's April 28th, 2023. Reminder, I'm an amateur investor, growth stock investor, not affiliated with MarketSmith or IBD. So the agenda today is to go over briefly the general market environment. We'll talk about some internals. We'll get into positioning, some sentiment. Then we'll look at market bottoms and recessions, and potentially do we have a catalyst going forward. And then, is earnings seasons like cigarettes? We'll discover that later in the presentation, and then we'll do a summary wrap up. So the market environment. This is a chart of the S&P 500 weekly chart. Fairly simple. We broke the downtrend line. Probably what's noteworthy is, we still are above the 10-week moving average and the 40-week moving average, which is constructive. It's slow, but it's constructive. I've drawn this red line. This is that zone between 4,100 and 4,200 still acting as resistance in the short term. And the relative strength line is showing us that the NASDAQ is outperforming the S&P currently. So this is from Ned Davis Research. This is a seasonality composite where they're taking a number of different things and weighting them. They're weighting the 1-year seasonal cycle. They're looking at the 4-year presidential cycle, and we're in year 3 of a first-term president. And then they're looking at the 10-year decennial cycle. And that's resulting in this dark line as they show up for a typical year. And then the dotted line in gold is 2023 so far. So as you can see, 2023 has had some overshoots to the upside, such as January, but we've also had some really overshoots to the downside with this major pullback in February and March, and we've come back up here in April. So it's been a little wild when you look at it relative to this long-term chart. But the question is, we are grinding our way higher. Can we get into more of a trend, an uptrend? It remains to be seen. So let's look at some of the market positioning. I showed this last week. I won't go over the details, but the bottom line question I asked was, we can see that money's being put to work. This is showing the exposure levels of active investment managers. The question was the repositioning, though, bullish on the long side or bearish on the short side? So let's look at a few surveys recently. This is the Bank of America survey. And what it's showing is by sector, where is their overweight and underweight? Now, this was done in April, and it's a global survey. And it's showing that this is probably the most bearish underweighting in equities since 2009 financial crisis. You can also see that there's an underweighting in tech and in the industrials. And where is the overweighting? Well, the overweighting is in defensive issues, bonds, consumer staples, utilities, cash, and healthcare, all defensive sectors. So this is really telling us that there's a lot of positioning on the bearish side. This is another chart from Bank of America, a global fund survey, looking at similar data. And it's just looking, again, at overweighting and underweighting. And you can see that equities have been down at a level that hasn't been seen since the financial crisis. We only dipped slightly below that in May of 2020, which is the COVID market, which was a very brief market. But the point is, there's a lot of weighting by managers on the bearish side, defensive side. This is a Bloomberg chart. This is the S&P E-mini shorts. And you'll notice that, again, this is the highest net short positions in the S&P 500 E-mini futures. It's the highest number of shorts since going way back to 2011, which was the, I believe was the debt crisis. The debt ceiling was an issue back here. So this is also showing a massive amount of shorting and bearish positionings as well. And JP Morgan also did a study recently where they asked clients and they asked other managers, and they found out what their thoughts were about where do you see the S&P 500 at year end. And, we're currently in the 4152 range for the S&P. So you can see, look at the amount of people that do not believe the S&P will be above essentially 4,000 at the end of the year. It's 95% feel that we will be lower than where we currently are. So this is really, again, everybody is on one side of the boat saying the S&P is going to be going lower by the year end. Very, very extreme. So let's look at the NASDAQ daily chart. And I've shown this for the past couple of weeks. And the premise was monitoring the selling pressure in the NASDAQ. And we had these declines. The first decline went down below the red line, which was the 50-day moving average. The second decline only undercut the 50-day for a couple of days, and it was less of a decline below the 50, so that was better. And then the third, we've been watching this the last few weeks, and I've been saying, and this chart has been noted with, even a decline to the 50-day, I said, would be improvement because it would be a smaller, less decline than the previous two declines, saying less selling pressure in the market. Now, on Wednesday, I put out a tweet with everybody positioned in the bearish side of the boat. Could they all be right? Maybe they are in the short term, but if we get a positive catalyst and it's possible that a failed downside break could thrust this market higher into the next bullish leg, breaking through this band of resistance shown in the orange color. So remains to be seen, but we did come back from that point, touch the 50, and now we're trying to rally a little bit, really bolstered by earnings this week from Microsoft and primarily Meta. Now, this is another different way to look at the NASDAQ. I recently came across some information that looked at the percentage of NASDAQ stocks that were down 20% from their 52-week high. So if we were to look 1 year ago in 2022 at the April and May lows of the market, 80% of the NASDAQ was off its highs by 20% or more. Now, here's where we are today. We currently have about only 25% of the NASDAQ stocks are down 20% from their 52-week highs. So there's some repair that's going on in the market. There's no doubt that definitely the NASDAQ 100 and primarily four of the large mega cap names are leading the index, but there is some gradual improvement under the surface versus seeing further deterioration and stagnation. There's no doubt the small companies on the NASDAQ, they might not make it through this bear market, particularly with interest rates spiking. They might just be further go out of business and come off the exchange. But there is improvement, and being only 25% off its 52-week highs, it could suggest that there's base building going on in a number of stocks within the NASDAQ that are actually within the range of 52-week highs. 20% deep bases are considered very, very normal in a bear market. So many stocks have come up off their lows, and it's possible they're forming bases. It's an interesting way to look at the NASDAQ a little differently to give us a perspective a little bit about what's happening underneath the surface. So the market internals, really briefly, this is the S&P. This is the net up-down volume ratio. Looking at up-down volume every day and getting a net result. You'll notice that back in March during the banking crisis, we made a new low in up-down volume. We kind of had a washout, extreme levels. Yet you'll notice that the S&P in the upper panel did not make a new low. It held up amidst the banking crisis, and many of the KRE index is also in the S&P. So that's actually a positive that the index is making higher lows, and you'll notice that the up-down volume has dramatically improved since that low, and we're actually reaching a level that we've touched upon 2 or 3 times since we had the market low. Be interesting to see if we can get back up to the higher end of the box, which was not seen since I think it was last July. Now, this is the NASDAQ and the S&P on the left, and the percentage above the 50-day moving average, not the 200-day, but the 50-day. You'll notice that there certainly is improvement in the S&P. We want to see it keep this direction. You can see there's been resistance up in this level around 70, but we'll have to see if that can improve. The NASDAQ is still pretty weak. We're still under the moving average, the 50-day moving average, and it's just been a lot weaker than the S&P. Now, market bottoms, recessions, and catalyst. So again, going back to Ned Davis research, This is a chart of S&P 500 and some markers relative to recessions. So they're trying to show all of these different markets which ended up in recessions. And they're trying to look at in this chart, where did the recession start, the recession start date, and where was the recession end date? And they're using some averages along the way to pin down those points. And then the scale on the bottom is showing us months after the recession started, so how long the recession was, and they're saying that the median is 10 months after it begins, and they've got some going backwards as well. So you'll notice that the composite of the index, it basically shows that the market tends to bottom. The market will reach a bottom maybe a couple of months after a recession has started. And it will be also, it's very, very typical that the bear market will usually be ended and the market bottom will be in before the official end of a recession. So this is really the important data point here is there's all this talk of recession. Maybe we're already in a recession. They haven't called it a recession, or most people are fearful we're going to have a very bad recession that maybe hasn't even started yet. But trying to use this as a guide from what we typically see as it relates to today's market. Now, here's a couple of historical examples of this in motion. This is the 79 to 82 market, and I'm showing this bear market that occurred between 81 and the end of 1982. You can see in here the market is grinding lower, and I've shaded the recession when it started. You'll notice it started before the market bottomed, and the market bottomed in August of 1982. And this was a very powerful bull market that launched. Now, the recession didn't officially end until January of 1983, but the market had already bottomed almost 4 to 5 months earlier, consistent with that Ned Davis chart. Here's another example using the devastating bear market of 1973-74. I've shaded. This is when the recession started, and it was a 16-month recession. So you'll notice as this market kept grinding lower, we finally got the follow-through day in October of 1974, where the market bottomed, had a follow-through day, and launched into a bull market. Well, the recession officially didn't end until March of 1975. So the point is another example of the market bottom occurring before a recession. So it's very typical that that happens, and I wanted to just show a few examples. We'll see how it have to play out this time. Now, I wanted to bring up the PCE index given today's report this morning. I mentioned that this was really the key indicator that the Fed is looking at. Months ago, it was in the 5 range. It's slowly been coming down. The goal, the Fed said, is to try and get this down to 2.5. Historically, it's been 1.7. So here we are with today's report. And this is taken from the website that shows the personal consumption expenditure report. This was the February report that it was at 5. You can see it's slowly been coming down. Now, what's interesting is there was a Barron's article, which really was looking at the lag of all these rate hikes. I'm sorry, that's a typo. It shouldn't say cuts, it's rate hikes. So what they did is they said, look, the Fed started raising rates aggressively in March of 22. And if you think it takes 2-3 months before the rate hikes start to take effect, really the rate hikes didn't take effect until the summer of 2022. And so they measured the PCE from July of 22 to February of 2023, basically an 8-month period. And the PCE was actually lower. It was only 3.3%, showing that the rate hikes had really started to bring down the PCE, much closer to the 2.5 level that the Fed is targeting. So it's showing us that if you look at this a little differently in terms of the lag, maybe we're making more progress. Now, today's PCE report for March was the report was 4.2, and it's 4.6 if you exclude food and energy. So the last report was 5, down to 4.2 now, and maybe this number is actually coming down at a faster rate. I think it's important that we pay attention to the next Fed meeting to see how they say. They're going to be likely hiking about a 1/4 point, but the importance of what does the Fed say about the PCE could be a really important catalyst to get this market going. So I wanted to take a a time to shift into earnings season because there's a lot of earnings report this week, and it's creating a lot of volatility in the markets. So are earnings seasons like cigarettes, and they can be hazardous to your health? This is just a really quick sample of some recent earnings reports this week. And I just tried to plot the earnings surprise and the revenue surprise. And then what did the stock do? What was the reaction? And you can see that there's a number of positive surprises and revenue surprises, except for a couple of them, Cloudflare and AYX, in addition to Snap. But you can see the reactions have been devastating. These are all actual numbers the day after the earnings report. And all of these numbers are as of this morning. They're all in progress, but they are all substantially down, at least 14% or more. We all know that the large mega cap stocks, such as Meta and Microsoft, they had a much more favorable reaction. I know Meta was really being driven by cost cutting. The market really liked all the cost cutting and operational cost cutting and labor cost cutting that Meta was doing. They think that will really help the results of getting the company back on track. Very positive reaction, over 14%. And you can see other ones, CMG, big earnings surprise, big revenue surprise, resulted in a big gap up. So this is all really speaking to volatility. So, the focus right now is definitely firmly on recession. People are positioning themselves bearishly. They believe a recession's coming. And so they're really looking at companies and say, how are these companies going to perform in a recessionary environment? Now, all this uncertainty has really resulted in further markdowns in some of these gross names. What it's all about really is guidance. If the guidance is weak, and it's referring to the recession going forward, it's really been dramatic markdowns. Look at these red numbers. These are devastating markdowns that are occurring in growth names. It also tells me that analysts' forecasting ability is very, very poor. They really don't know what the earnings and sales will be for these companies. And it's resulting in all these dramatic gaps up and gaps down, which really are making it really quite hazardous to your health to be holding stocks through earnings report right now, because they're just really a crapshoot. Now, usually the market will look ahead 6 to 9 months. And regardless of what the company says, if the market's looking ahead, it will tend to shake off and shrug off any weak guidance and any weak news because they've already discounted it in their forecasts. Now, that clearly is not the case right now, given these massive gap down that we're seeing in companies where the street seems to be incredibly surprised by the weak guidance and their analysts' ability to forecast it. So it's resulted in a very treacherous environment. You have to be very, very careful if you want to hold anything through earnings right now. So the overall summary is, I feel there's still really heavy bearish positioning. And the question that gets begged is, can everybody be this right about, leaning on the bearish side? My tweet suggested that maybe if we get a failed breakdown, we could actually get a rally higher. The PCE report, today's reaction is not as strong as maybe I thought it might be, but it still might be a catalyst. I think we're going to have to watch the Fed talk at the May meeting, and usually it might take 1, 2, 3 days for the street to absorb the report, hear from the Fed, and then maybe we get some more positive action. The chop continues, the consolidation continues. Again, it's difficult to sit with positions unless you have some good cushion. I certainly wouldn't be adding to anything right now. Staying in cash is a great position to be in, but we need to also stay open-minded. Things can change very quickly in the market, and we want to be really nimble and open-minded to take advantage of it. So as Vince Lombardi said, this is not an easy game. And he said, it's not whether you get knocked or down, it's whether you get up. So that's really, really important. It's a huge, very tough environment right now. Stay with it, stay engaged, and you want to be really prepared for the next big bull market. That's the general market update for today, April 28th, 2023. I'm John Pocaroba. You can reach me at Twitter, YouTube, and email. We'll see you all on the next general market update.